Peak Wealth Management proudly presents Finding True Wealth with certified financial planner Nick Hopwood and accredited investment fiduciary Jim Pilat. Nick and Jim believe by making simple, good financial decisions, you can retire with confidence. And now, let's turn it over to your hosts, Nick and Jim.
Welcome everyone to episode 81 of the Retire with Confidence podcast. I'm Nick Hopwood.
And I'm Jim Pilat.
And we are with Peak Wealth Management, where we want to help you retire with confidence. So it's been a couple weeks since we had an episode in general talking about the markets and what we're seeing. We've had a couple of videos that we posted recently, which we'll cover, but we wanted to come back and give more of a comprehensive view of where we've been and what our thoughts are now.
Yeah, some of the recent developments, I guess. The market's moving so quick. We probably can't do enough updates, can we?
Yeah, we'd have to do like 3 updates per day maybe to get fully up to speed. But we hope that you're doing well. We hope that you're safe. We haven't had any notifications from anyone I know in my whole spectrum of contacts who has fallen victim or had any sickness at all. Yeah. So that's good.
Yeah, so, let's pray that continues, huh?
Absolutely. And we're here. We're open. Financial services is, what do we say?
Essential industry.
Essential industry, yeah. We're here for you if you need anything, right? Money related particularly. So let's talk about where we've been over the past month. Actually, I think the all-time high was February 19th, and today is the 27th, so about 5 weeks. We've been on a roller coaster. So the market, as measured by the S&P 500, from February 19th until March 23rd, was actually down 35%.
It's pretty steep.
It is, and it was the quickest drop to 35% ever.
Yeah.
It seems like the speed of information with the internet and everything, with media, everything travels faster.
Yeah, I agree with that completely. I feel like, news travels fast, panic travels fast, right? When, people post pictures on Facebook of whatever, a bare shelf or terrible day in the market or whatever it is, but it circulates so quick. Yeah,
and the obsession with number of new virus counts or new deaths, it's like an obsessive compulsive issue.
Yeah, I saw an interview from a guy the other day, and that was the comment he made is, if we posted the statistics of traffic fatalities every day on the news, you'd be afraid to drive. If we posted the statistic, whatever it is, right? If we focus on it so intently, it can't help but cause some panic, right?
Yeah. So until March 23rd, we had that 35% drop, and then between March 24th, so the low of the 23rd, we'll say, until yesterday afternoon, Thursday's close, it was actually a 20% rebound. And that was the quickest rebound ever.
Yeah. It's fascinating, isn't it?
It is.
It moved just as quick up as it had been moving down.
Yeah.
Right? The swings we've seen are just...
Yeah. So that 20% rebound doesn't mean that it's over, okay? I want to make that clear. We're still seeing the S&P down 20% even after that 20% rally. And so remember the math with percentages. If you lose 50%, you have to earn 100% to get back. Yeah. If you lose 35%, you have to make 40-some% to get back. So getting a 20% rebound still means that we're down 20, even though the original number was 35.
Yeah, good point.
Yeah.
Yeah.
We also think that we want to be aware of what pattern might come next. Right? People are talking about a V-shaped recovery, an L-shaped recovery, a W-shape. Well, we don't know, but we think that it's very important to be aware of bear market patterns in history.
Yeah.
And the double bottom pattern, which would be like the shape of a W on the stock chart. If you look into prior recessions, prior bear markets, you oftentimes have a retest of the lows. So that low on March 23rd, which was down 35%, we very well may go back there. Revisit that.
I think because the markets move so fast, we can't ignore history, right? Historically, double bottoms, things like that are very common. But just because the market moves quicker doesn't necessarily mean that the patterns change, right? So we can
Right.
snap down quick, we can snap up quick, we can retest quick, we can do all those things quick, but it would not be uncommon at all to see that happen, to still see that double bottom.
Yeah, so maybe you have the similar pattern as before, but instead of taking a year for it to play out, it takes 2 months for it to play out.
Yeah,
Right? This is the quickest drop, and we've seen a correlation between the length of the drop in terms of time. Like
Yeah.
how long did it take to get down,
right.
and how long did it take to recover?
Yeah,
Right? We can just shrink all of that 2 years into less than a year, or 1 year into a few months.
right.
I mean, in 2018, when we had a 3-month drop to 19%, it was a 3-month recovery to get it all back.
Right.
And that oftentimes would have been a much longer pattern.
Yeah.
So we want to just make sure you're aware that just because we've had this 20% jump does not mean that we're into a new bull market or anything like that.
Yeah.
Also, in our conversation 2 weeks ago, we talked about the fact that we're probably going to have a recession. And I think that's pretty much confirmed here, right? And we've had this, it was yesterday, 3 million new claims on unemployment.
Yeah.
And, that's a lot. It's never gone from, almost 0 to 3 million.
Yeah.
It's never happened.
Really, really big jump.
Yeah.
Of course, but also not an unanticipated jump, right?
Right.
And it's and to a degree largely priced into the market as well.
Right. I mean, the market rallied on that news all day.
Yeah.
So it seems like the market was probably expecting a
Yeah.
worse number.
Yep.
And maybe that worse number will come next week.
Yeah.
All right, think about the investor psychology. We're still getting new cases every day. We're going to have new unemployment. It's going to continue, right? So the market psychology evolves and changes over time.
Right. Yep. I just got an email right before we came in here from a client who said he got his layoff papers on the 25th. That was just 2 days ago. So there will be more. The number will change, but again, just because it's bad news doesn't mean it hasn't been factored in some way as well. The market's very efficient in how it prices news nowadays.
Yeah, but it usually overswings, right? The
Yeah,
pendulum
it does.
swings, right? Pendulum swings too far one way, and then it figures out that it's wrong, and then it swings back the other way.
Right.
Probably both ways swinging too far.
Yep, I would agree.
Another quick story. Yesterday after work, I felt like the family might need a little sweet tooth
Okay. Yeah.
fix. Okay, so we have Grand Traverse Pie across the street. Stopped in on the way home for a pie. I was going for blueberry, but the inventory was very low.
Okay.
So we had to settle for apple, which is fantastic. Okay.
It's hard to go wrong. Yeah,
Right.
Classic.
Yeah. But there's nobody there. The dining room's closed. Right. There are 2 people working, and like I said, there's not a lot on the shelf. And I asked the lady, how many people work here? Because I only saw 2 people. She said 35 people work at the pie store. And I said, well, how many people are still working? She said 4. And I thought, well, maybe they're all part-timers. She said 30 of the 35 are full-timers.
Wow.
And there's only 4 that are working right now.
Yeah.
So that really hit home.
Right. Yeah. That's a good illustration.
Yeah. So we've had the Federal Reserve step in with cutting interest rates to 0, with support to the money markets, support to municipals, support to corporate bonds, commercial paper. These are unprecedented moves. Now, they did a little bit of this in 2008, 2009, but now they've taken it to the next level.
Yeah. Absolutely.
And basically, Chairman Powell said, we're going to do whatever it takes.
Yeah, and I think that's obvious, right? In the moves and the steps that they're making, they understand that this is impacting a lot of people. Making people stay home. We're essentially shutting down the economy. It's going to have a big impact, but the Fed is stepping up and saying we're going to do what it takes, and we know this is going to cause some pain, but we know we're on top of it, and we're working to make it the best we can.
Yeah.
So I think that was a positive.
And then Congress now, probably today, will be voting on the, and I can't remember what the name of the bill is, but the $2 trillion package, which will be helping small businesses, big business, checks to people that make, I think it was something like under 100,000.
for individuals.
Yeah.
Married couples is
Married couples.
It's twice. It's 150, and then it phases out beyond up to 200.
Okay.
Yeah.
Right. So a lot of people will be getting checks.
Yeah.
There's other things that they've talked about, and we'll see how it turns out. Right.
Mm-hmm.
This is just speculation here.
Yeah. Until it's signed, it's
until it's signed. They are talking about waiving the 2020 required minimum distribution.
Mm-hmm.
So for people that are taking money out of their IRA, and maybe they don't need the money, maybe they have a nice reserve already.
Right.
They can leave that money in their IRA.
Mm-hmm.
Also,
which is big, right? Because if their IRA took a beating because they were maybe more aggressive than they wanted to be, it gives that IRA time to recover.
Yeah.
So
they did the same thing in 2008. Actually,
Yeah.
They waived the required minimum distribution.
Mm-hmm.
This is also something new that we've been reading about, where folks who are affected can pull money out of their IRA without paying the penalty if they're under 59 and a half.
Yeah. Yeah, that if you find yourself in a crisis situation and needing access to money, that could be an option. We'd caution you about making that the first place you go, but we can definitely have a conversation with you when we know more about how that will specifically work.
We also want to highlight some of the recent videos that we posted this week. We've been, kind of talking and making sure that we hit certain views, certain things to remember during times like this. One of the videos we did was the cycle of emotions. So you can go back to the blog, peakwm.com/blog, and you can see each post. Okay. You can also visit the YouTube channel, youtube.com/peakwealthmgmt.
Okay.
Keeping everything consistent, right?
Yeah, I like it.
But they're short 2-3 minute videos, so really quick hits.
Yeah, but I think they're important. I think people underestimate emotional investing, right? It impacts so much, with the decision making that we have as our emotions, and I think that was really helpful to go through and look at that chart and understand that you're normal for feeling frightened or scared or anxious or what am I doing this for, right? Those thoughts and emotions are all very common.
Yeah, and we also talked about on that chart how when you feel the best is really the maximum risk,
right?
For maximum financial risk. When you feel the worst, maybe like on March 23rd, that's the point of maximum opportunity, which is counterintuitive.
Yeah.
Okay.
Yeah, it goes against most people's comfort level for sure, but
yeah,
history has shown that you're correct.
We also talked about intra-year drawdowns, and what a great example we've just seen this week, where intra-year we see a drawdown of 35%, and then if the year ended today, or let's say yesterday at the close, we would only been down 20% for the year.
Right.
And we looked at other years like 2009. 2009, there was a huge 30% drawdown, even after 2008, which was bad. 2009 had a big drawdown from January 1st until March 9th, and then it finished the year plus 20-something.
Right.
So it went from about minus 30 to plus 20-something. And that's a huge rebound. And that was the beginning of this bull market that we just saw. What was the other year that we were looking at?
2001, I believe.
2001?
Yeah.
Right, so after 9/11, we had a huge drawdown, and then a month later it was actually up after 9/11.
Yeah.
We talked about bear market recoveries as well, and this one had the most data, right? It was a very busy chart, but bear market recoveries, thinking what's the average time from the all-time high to the low point of the cycle, and what was it, 12 months?
Yeah.
And then what's the average time from the low point to get back to the high point? And I can't remember what the number was on the chart, but we saw recessionary periods and non-recessionary periods where we had bear markets. And we learned that in recessionary periods, it was usually deeper, right? Like 37, yeah. Yeah, 37% was the average drawdown in a recession, whereas a 30% drawdown was the average bear market if you didn't have a recession.
Yeah.
So, kind of interesting.
Yeah, I think one of the big takeaways from looking at that chart again was the correlation between speed of the drop and speed of the recovery. And I think, and also if you look at more recent history, the drops have been quicker, the recoveries have been quicker, and I think it all ties back into what we started talking about is the speed of information, right? It's so available now that the market, and the market's so efficient that it just prices in news so quickly, as opposed to, in the past where it could take months to accomplish what now takes us seemingly weeks or hours,
Yeah, I mean, in 1987 with the big drop, right, you had to pick up the phone and call your broker in New York or wherever, and maybe they answer, maybe they don't,
Maybe they're on the phone. It's
right now you're just pushing, we're just clicking the button
Yeah.
and moving millions of dollars in seconds.
Yeah, instantly.
And the big institutions are moving billions in seconds. So everything moves quicker. Yeah. And then one that you probably haven't seen yet because we have not blasted it out is How to Survive an Anaconda Attack, which is kind of a cute story, but it does apply to bear markets as well. How to survive a bear market attack.
Yeah.
Kind of a parallel to How to Survive an Anaconda Attack. So rather than going through and rehashing that, we'll let you go back and watch that one. It's a quick one as well. Any closing thoughts here?
Again, if people, still have some anxiety, we're here. We're welcome to, take phone calls. We're happy to do that. But again, I feel like the theme that we've tried to portray to people over the last several weeks is, this is why we have the plan in place. This is why, we set aside money, why we have emergency funds, why we do these things that at the time maybe don't seem fun or practical. Like, why would I want to leave my money on the side when the market's going up 20% a year, right? This is why, right? This is why we need to be cautious. This is why we need to protect and make sure that we have a good plan in place.
And this is also why when we have in our meetings, we talk so much about risk. We talk so much about the planning when we put your financial plan on the screen and talk about the probability of success and the sequence of returns.
Yeah.
Right? If you retired in October of 2007, right, you had a 50-some% drop staring you in the face for your first 2 years of retirement. Versus if you retired in 1991, you have 9 years of 20% a year in front of you. It's a big difference with your retirement cash flow.
Yeah, huge.
Okay, like my mom retired in October of 2007. I tell people all the time, especially in times like this, and it adds a stress, right? But we adapt. And we move through. We stick to the plan, and we make it work. You said emergency fund. You said we talk about debt management all the time, right? One of the things that we learned, from 2008 is that debt can sink the ship.
Yeah.
Okay. And if you have a lot of debt and no emergency fund, you're toast.
Right.
Like all these companies right now that you're seeing, who are, in trouble. Okay. It's been less than a month, where the economy's kind of been shut down, and they can't handle it.
Yeah.
Okay, if they had a reasonable debt load and a reasonable cash surplus, some reserves, you can weather the storm. Like, if you lose your job, you have 3 months, 6 months, right? And you can get it through it.
Right.
Yeah. Right? This is why we preach these things.
Yeah, it's been a little eye-opening just to notice all these corporations and companies that are struggle to keep the lights on after a couple weeks of shutdown.
It's very It's disturbing.
Yeah, because there's zero reserves.
I'm disappointed in them.
Yeah,
quite frankly.
Yeah.
So I think that's it. It's Nick and Jim with Peak Wealth Management. We want to see you to and through retirement.
You've been listening to certified financial planner Nick Hopwood and accredited investment fiduciary Jim Pilat on the Finding True Wealth podcast, sponsored by Peak Wealth Management. You can learn more about Peak Wealth Management by visiting peakwm.com or follow on Twitter at nhopwood1.